We're in a really interesting period here, the relationship between the U.S. and China and the capital markets. How would you characterize the reaction to some of these names last week? Was it in line with the news or not?
Well, we think there was a significant overreaction. You know, the week of Thanksgiving, we had a very light volume, but we had a very poor news cycle where a lot of negative headlines really weighed on the names in a pretty weak tape from a volume perspective. And last week, again, we had another round of negative news, just DD outlining how it may delist from the U.S. exchanges, as well as the SEC articulating how they're going to enforce the Holding Foreign Companies Accountable Act.
So you're a skeptic on the notion that somehow China's looking to kill its technology leaders, right?
Yeah, 100%. I mean, these companies account within KWEB for 1/3 of all retail sales in China. You can't see 1/3 of retail sales just simply go away. At the same time, the regulation has not been problematic. It's really been the implementation of that regulation, the way it was done in terms of multiple regulators moving at different speeds, really created this negative narrative, negative news cycle that's really, really weighed on the space, Carl.
Right. So what puts a stop to that, or do you think we're already there?
Well, we think from the regulatory cycle, we very likely are over that. The user data, user protection laws went into place September 1st, November 1st. What we really need is some catalysts. And we think that the CSRC addressed many of the issues that have been weighing on the names over the weekend. On Sunday, they put out a press release saying they're not trying to kill these companies. They're not eliminating VIEs. They're not going to disallow foreign listings, as well as they're trying to solve this long-running PCOB issue that led to the Holding Foreign Companies Accountable Act.
Brendan, it's Morgan. I mean, that may be true, but we're seeing the clampdown in both countries right now. I mean, the SEC is taking a tougher stance as well. I mean, we can point to this DDD listing. Is it going to continue to fuel, I guess, the disentanglement of U.S. and China investor flows as this continues to evolve?
Well, the two countries are highly, highly intertwined from an economic perspective. China's trade data continues to show that it's not only a large exporter, but a large importer. We saw, say, the Boeing news about the 737 MAX being approved in China. Apple's revenues doubled in China in Q3 from $7 billion to $14 billion. So the countries are very, very intertwined economically. That can't go away. I mean, almost $400 billion of revenue is generated in China from U.S. publicly traded companies. So this is a big issue. So ultimately, the two sides got to get together and figure this out. On the Holding Foreign Companies Accountable Act, the companies are really in a bind. They were allowed to list here, and now this law has them stuck between U.S. law and Chinese law, as well as over, about 1.5 trillion of U.S. savers. It's not Chinese capital in these stocks. It's U.S. savers are in these names. And it's really an unfortunate situation for both the shareholders as well as the companies stuck between these two conflicting laws.
Shepard Smith here. Thanks for watching CNBC on YouTube.